Australia's rental market is in crisis, with vacancy rates dropping to an all-time low and rents skyrocketing. In today's Property Insider chat, Dr. Andrew Wilson and I discuss the latest My Housing Market rental report. And unfortunately, there's no relief in sight for tenants. We also discuss a couple of factors that are going to affect the Reserve Bank's interest rate decisions, including the latest inflation figures and retail figures. Inflation's coming under control, but we're spending like drunken sailors. What does this mean for inflation and for interest rates? Well, you'll find out as I chat with Dr. Andrew Wilson. Now, if you want to keep up to date with our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. Australia's rental market is in crisis. Vacancy rates have dropped to all-time lows, rental stock remains extremely slim, and rental prices continue to skyrocket. So how did we get to this crisis, and how long will it last? These are some of the questions I want to ask Dr. Andrew Wilson, Australia's leading housing economist, as we discuss the latest My Housing Market rental report. I also want to ask him about the latest CPI statistics and some retail figures that will influence the Reserve Bank's interest rate decision moving forward. And as usual, we're going to dissect last Saturday's busy auction market. Hi, Andrew.
Yes, good day, Michael. And another month, another bad news story for tenants. I guess more positive news for landlords because incomes for them are increasing. But sadly, rents are also increasing for tenants. And it's a bit of a same old, isn't it, Michael, from month to month? Trying to bring some refreshing news, but it remains the same. It is, I guess, a crisis in our rental market from the perspective of tenants. Look, if I could just point on a few trends, maybe we seem to shift between tighter markets for houses and tighter markets for units. I don't know whether that's a preference swap that's happening, but from period to period, as houses become more expensive, we get a shift towards units, and then units then shift back to houses, etc., etc. We've had a little bit of that this month over February. Of course, it's I guess we could say the first major month of the year. Now we have January behind us. So I think there were some seasonal impacts with the January data we had, which did show some easing in vacancy rates and rents. But we're back certainly on the tight train now. And that latest February data is not good news. So although unit rents, as I mentioned, are showing just some slight signs of easing in some of the capital city markets and perhaps an underlying trend there, but I wouldn't get too excited. But unfortunately, house rents are still rising in most capitals.
Well, Andrew, you said same. Interestingly, this has been going on for a couple of years. So I remember as a landlord when my rents increased by over 10%, the first time I was happy, having not had much increases for a while. Now it's second time round it's happening. So lots of investors are getting a number of years in a row of double-digit rental growth. But as you say, unfortunately, that isn't good news for tenants. And with minimal construction of new apartments and fewer investors getting into the market, I can't see any change in the supply of rental accommodation in the foreseeable future, Andrew.
No, it's stuck along the bottom, I guess, just bouncing along the bottom of the market, and in terms of particularly vacancies for properties. And it's not unusual to see crowds of prospective tenants outside advertised properties. So it's not just higher rents, it's just how tough, or having to pay more rent. It's just how tough it is to secure a property with you've got so many competing prospective tenants just about for every property. And that's a prospect, of course, or a realisation of the reality of the vacancy rates being so low. But yeah, house rents, we'll start with house rents, Michael. Generally, most house rents increased or were flat over February. Sydney, Adelaide and Perth were flat. Melbourne and Brisbane up by 0.8%. Darwin, which is a volatile market, of course, we know it's a smaller market and has seasonal impacts, but it was up by 2.9%. Canberra up by 2%. The only market to fall was Hobart, was down by 0.9%. You mentioned the annual growth. The top performer there is Perth. House rents up 16.1%. Melbourne up 15.5%. Sydney up 14.7%. Brisbane up 10.7%. So double figure growth in those capital city markets. Hobart and Darwin actually rents for houses have fallen over the past year. Canberra up just a tick by 0.4%. But vacancy rates over February were generally actually lower or steady. Vacancy rates in Sydney, Brisbane, Darwin and Canberra were lower, and they were steady in the rest. And of course, that follows what was a slight easing over January. So perhaps the seasonal effects of January have worked their way out of the market and we're back to sort of normal. But these vacancy rates are ridiculously low. The lowest vacancy rate we have amongst the capitals for houses is just 1%. We have Adelaide and Perth at 0.4% vacancy rate. It really doesn't matter once you get under 1% of what the increment is, because it's basically telling you that there are no houses for rent. And that's why we see once we get to that sort of ground zero level, it's very difficult to shift, because we really need thousands and thousands of new homes. And of course, we also need less demand. And in an environment of still high migration, that's not going to happen. When we look at the actual rents to compare them, Sydney has the highest rent, weekly asking rent, Michael, $780 a week. Hobart the lowest at $550 a week. Sydney rents are still tracking the best part of $200 a week. House rents above Melbourne. That shows you a big difference there. And last week, of course, we looked at average weekly incomes, and they're not much different between Sydney and Melbourne. It just shows you how tough it is in Sydney too, in terms of proportion of your income to meet your rental payments. So house rents looking again tighter, vacancy rates steady at low levels or falling, and annual rents double figure for most of the major capitals, for all the major capitals, and rents rising or steady. Perhaps some better news for units, Michael.
Well, Andrew, it seems that people are now, because of affordability, moving to units. They're also living differently. Some are staying home with mum and dad a bit longer. Others are starting to share again, getting back to the way many of us lived prior to COVID.
Yeah, look, maybe it's something we could speculate on, Michael, that the increase in demand and higher, particularly over the last month or two, for house rents, which are more expensive, of course, than unit rents typically, maybe about that sort of combining of families and combining of tenancies, because of course typically you have more bedrooms and more space in a house. So perhaps that's higher demand is coming from those that are prepared to share their tenancies, moving away from apartments to some degree because of the less space available typically in apartments. And that might be, as we've discussed here, the signs of the social change that's likely to happen in this terrible rental market. And as you said, we're talking years now that we've had this situation. So this is, people have to make choices, and that's one of the choices, is to share accommodation. And maybe that's why we're seeing higher demand for houses and a little bit of easing for units. But I think at the end of the day, what happens is that higher demand for houses, higher rents for houses, eventually pushes people back into apartments because they just can't afford it. It's a dog chasing its tail to some degree. But when we look at the unit rents for February, we can see Sydney, Brisbane and Adelaide were all down by 1.6% over the month. Hobart down 0.5%, Darwin down 1.8%. Rents in Melbourne increased for units, and there's been certainly a surge in rental demand in Melbourne, and rents have been consistently rising for units there over the last 6 months or so. Canberra was up 0.4%, Perth up 1.7%. But it's interesting, part of that story of when we differentiate between Melbourne and Sydney, Sydney's median rent is $723 asking rent for a unit, whereas Melbourne is similar to houses, the best part of $200 lower than that at $580 a week. And I think that's what's that affordability differential. And we compared the incomes between Melbourne and Sydney, which aren't that different, I think is pushing rents up strongly in Melbourne for units. Over the year, similar story to houses. All the major capital cities have reported strong growth in rents over the past year for units. Melbourne and Perth, number one. Perth up 20%. Melbourne a little bit under that, 19.6%. Brisbane unit rents up 18.7%. Sydney up 14.7%. Adelaide up 9%. All the capitals, with the exception of Darwin, have reported increases over the past year in house rents, and Darwin house rents are flat. When we look at the vacancy rates for units, again, most vacancy rates, even though we had some easing in rents in terms of rent declines, vacancy rates were lower for most capital cities, or steady over February for units. So not a lot of good news there. Sydney, again, the highest rent at $723 a week for a unit, median asking rent. Adelaide, again, the lowest median asking rent for a unit at $465 a week. And as we discussed, Michael, there's really no light at the end of the tunnel here for tenants. More sobering results. Vacancy rates are still falling. They're at crazy low levels at the moment. As I said, it just shows what sort of competition there is for available property. Unlikely to have any relief in the foreseeable future, because as you suggested, Michael, we have these chronic housing shortages, which obviously those vacancy rates reflect, and they're exacerbated by falling home building approvals, no sign of a revival there, and still high migration.
Interestingly, over the weekend, I walked past the office of our local councillor here in Brighton, or state member. I didn't realise that it was a Greens party here, and big poster in the front window about rental freezes and to bring them in. I'm glad the sitting governments, though, were smart enough not to do that, because that would only push vacancy rates down as investors move out of the market. Now, we're all interested in what the Reserve Bank's thinking about interest rates. There's so much speculation in the news about it, Andrew, and there's been a couple of clues that have come out over the last week: inflation and retail figures. Let's look at each of those in turn. Annual inflation remains steady this time round.
Yeah, we've seen some steady drops or falls in inflation, Michael, the headline inflation rate, but maybe we're sort of starting to see that steep decline from the highest levels we'd seen in decades, due to the supply demand issues from COVID. But we're now starting to see that decline easing. Annual inflation growth up by 3.4% over January, which was the same as the December result. And we have had quite steep falls over previous months, with a couple of exceptions which did activate the Reserve Bank. So I think that's why we're seeing certainly a circumspect attitude from the Reserve Bank with its recent statements, which we've discussed recently from their minutes, which have said that, look, don't rule out another rate increase. They said that still could happen. Underlying inflation, which of course is the preferred measure for the Reserve Bank, was actually lower at 3.8%. So that's heading down. That's from the 4% result over January. So that continues to fall. Housing was a significant contributor, up 4.6%. Annually, food up 4.4%. Housing has eased slightly, but it's still obviously a big drag on the overall inflation rate. Fuel was up by 2.3%, which is down sharply from the 5.3% the previous month. Now, remembering these are monthly figures, so they can bounce around a little bit, but I think now we're focusing more on the monthly figures than the quarterly figure. And we know, as we've discussed, that fuel is a significant, or has been a significant factor in high inflation. Just on that, Michael, today it was announced that the OPEC countries are looking to reduce supply of oil, and the reason is they want to get the oil price higher. The point is, even though underlying inflation is now at 3.8%, which has certainly come down significantly over the past year, it's still ahead of the target range of 2 to 3%, RBA's target range of 2 to 3%. So look, no good news, particularly for those predicting lower interest rates, official rates. And it's really a wait and see so far result from that inflation data, the latest inflation data. And the charts quite clearly show the big decline that we've had over the past year. A year ago, annual inflation was 6.5%, Michael. That's underlying inflation, the annual growth, which is the Reserve Bank's measure, and now it's 3.8%. So we've come down. We've still got some work to do before we start talking about certainly cuts in interest rates.
Well, the Reserve Bank's been wanting to get down inflation by stopping us spending. One of the ways it's done that is cause interest rates to rise, meaning we've got less money in our pockets. But retail sales have sometimes defied the Reserve Bank's wishes. We still seem to be out there spending, Andrew.
Yeah, we are, Michael. And I don't know, there's a lot of commentary around there that retail spending, consumer activity has declined in the face of higher rates, which you would expect. But I think given we still have a very strong economy, although we're starting to see the trend in the unemployment rate just picking up, probably a bit more to do with the high migration rather than higher rates, but probably the rates that have contributed. But we're still spending like drunken sailors, as I say, consistently. The latest retail sales data, which was for January, was up by 1.1%, and it's still up 1.1% compared to January last year, Michael. So we're still increasing to where we were a year ago. Now, obviously, there's some inflation issues as part of that factor, as well as migration. But nonetheless, the trend is still up on a month-to-month basis. And that increase of 1.1% followed a big fall over December, that 2.1% fall over December, which we expected, of course, because we had the strong November sales, which we get every year now. And that's always followed up by the December dip, because we are really transferring a lot of those sort of Christmas sale activity through December into November now, the Black Friday sales. And that means we do get that surge in November, the dip in December, and of course now we've bounced back over January.
I think people are waiting for those sales again in January, the Boxing Day sales as well. It's reasonably predictable, isn't it?
It is. And like I said, it was quite a strong month, 1.1%, still higher than a year ago. And we're well above where we were when we look at the retail sales data. We're tracking at just under $36 billion a month, which is well ahead of the $27 million or near $28 million we tracked prior to COVID. So we're well ahead of that, about 40% higher still, even though, of course, we have to account for inflation and strong migration. But nonetheless, even accounting for those factors, we're still spending quite vigorously at the moment, and there's nothing there to suggest that rates are sort of working. In fact, again, it's sort of adding to the argument that we haven't really quelled demand enough. Be thinking about, firstly, maybe not even more interest rate increases, which the Reserve Bank has stated are still a possibility, but certainly it's not justifying any sense of cuts to interest rates. And cuts to interest rates are a little nonsensical in regard to Australian rates, because we're about 1% below US rates. So I think we'd have to start at least seeing the US cut rates before we even considered it, particularly in the sense of what would it do to our currency if we started cutting with the US. And steady as she goes, I guess, type of results there for inflation and retail sales, Michael.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, our regular viewers would know that every week we also talk about the auction results. We do that because it gives us a good indication of what's happening on the ground. This weekend, before this upcoming long weekend, the weekend we've just had very large number of auctions. Having said that, it was an encouraging weekend for sellers.
Yeah, look, we've had an unbelievable start to the year, Michael, in terms of the number of properties going under the hammer. It's been a record February for the number of properties auctioned, and it's been a record February for the number of auction sales as well. So it's not as though sellers are active and buyers aren't. They're both active, and we've seen record sales numbers as a result of record listings and still quite solid to strong clearance rates. In Melbourne, we get the long weekend for Labor Day coming up. It's a week later this year, so that's probably why we've seen a little bit fewer auctions this weekend compared to what we normally have as a Super Saturday prior to that public holiday, but the numbers were still quite high. It was still big numbers, down from the previous weekend, which, as we discussed, was quite extraordinary the last weekend of February. In Sydney, we had 851 auctions, which is still a very big number, but it was below that remarkable 1,004 we had the weekend before. But the clearance rate in Sydney was actually higher, Michael. 74.9%. Those mid-70 clearance rates certainly reflect a market that's positive for sellers. As I mentioned, we're getting a lot of sales coming through, so buyers and sellers are in the market. And when we look at a year ago, the same Saturday a year ago in Sydney, it was just 674, so 200 extra auctions this year and a higher clearance rate as well. Another very big weekend in Melbourne for auctions. Again, we've sort of had a dual Super Saturday environment, Michael, I think, prior to the long weekend holiday, but 1,144 auctions in Melbourne, down from the 1,263 record February that we had the week before. Clearance rates may be reflecting a lot of that stock that's come into the market, more competition amongst sellers and more choices amongst buyers, down a little bit, 65.4% versus 68.5%, and still lower than where it was a year ago in Melbourne at 70.7%. Melbourne still has a bit of work to do compared to Sydney in terms of its housing market activity. We're sort of waiting for a revival because the Melbourne market certainly presents a good value at the moment. And I think buyers recognise that. It's just that we've got to take that next step, I think, in Melbourne to bring prices back up again. Although they're growing, they're not certainly growing at the rate we're seeing in the other capitals. Brisbane also had fewer auctions at the weekend, 77 versus 102 the previous weekend. Good clearance rate for Brisbane there at 68.3%, higher than the weekend before. And auction numbers also higher than the same weekend last year, Michael, in Brisbane, and clearance rate around about the same. Adelaide, similar auction numbers, 102 auctions in Adelaide, good number. Just under 80% clearance rate in Adelaide, similar to what Adelaide had, a little bit lower the weekend before. And certainly the clearance rate was higher than the year before, and the numbers of properties auctioned in Adelaide were lower. Canberra, it's starting to look like the Canberra market just picking up again, similar in terms of value opportunities to Melbourne. Canberra's been a market that's certainly underperformed, particularly compared to Sydney over the past 12 months, or certainly since the middle of last year. Just some signs there with a 63.3% clearance rate, similar to the weekend before, and auction numbers quite healthy there for Canberra at 87. So good start to the official autumn selling season, Michael. Quite robust in most markets. Some not performing as well as others, but Melbourne's had a remarkable number of auctions conducted over the year so far. So perhaps a little bit of an excuse there for a lower clearance rate. But going forward, Sydney's still a very strong market, Michael, and the prospects are that it's going to have another positive year. And when we look at the comparisons this year to last year on the full monthly results, Sydney's still tracking where it was a year ago. The Melbourne market, a little bit lower than a year ago. We discussed that. Adelaide, similar to a year ago. Brisbane, higher than a year ago. And Canberra is higher than a year ago as well. So, as I said, some positive news there for most capitals to start the autumn selling season, Michael.
That's really scary that we're into autumn already. But it's been a good year for property, or so far, the first couple of months. Look forward to catching up with you each week to have a talk about what's really happening out there. See you then.
Thank you, Michael.